St. Louis Fed President James Bullard addressed the state of the U.S. economy monetary policy at an event in Illinois earlier today. Bullard saying a slowdown could be sharper than expected due to a few economic downsides.
There are a few downside risks to the U.S. economy that could make this slowdown be a little sharper than what we're currently expecting. If that happens, it might be harder for us policymakers at the Fed to hit the 2% inflation target that has been established in the U.S.
Now, this after expressing his disapproval over last week's Fed rate cut of 25 basis points. He wanted to see 50 basis points. He believed it would have been appropriate. Joining us now is Michelle McKinnon, Senior Wealth Advisor at Payne Capital Management. Michelle, welcome.
Thank you.
So is Bullard right? Should the Fed be more aggressive right now?
I mean, the Fed's got such a tough job because not only are they conflicted between, here in the United States, we have an extremely strong consumer, but we have slow inflation and we also have a slowdown in manufacturing numbers. Then they look overseas and you have even slower growth and you've got negative yielding bonds in Europe. So that's also affecting our long-term bonds because you've got more people wanting to buy them. So I certainly wouldn't say that we should have seen a 50-point cut because I think that would have signaled more of urgency, and I think that also would have communicated to the markets that it's a lot more negative than what Powell has previously said. So I don't agree. I think 50 basis points would have been too much, but I think 25 probably was the right number.
Yeah, this certainly is not a textbook economy in any way. It's not behaving the way you think it would behave. So their playbook is sort of out the window.
Yes.
We know that we have a divided Fed here, right? That some policymakers thought we shouldn't have moved at all on interest rates.
Right.
So you've got Bullard wanting to get more aggressive. Should investors be worried that there is this divide within the Fed?
I think it's healthy because people don't really know what's going to happen, right? You've got different signals that are hard to understand because, again, coming back to the consumer, that's strong. But you've got really low inflation. Well, low inflation isn't the end of the world, but however, we have potential disinflation. And then the idea of, okay, we want to get ahead of the curve, that's a thought. But what happens if we do go into recession and we don't have ammunition, stored up? So I actually don't think a divided Fed is that bad of a thing.
So the latest dot plot shows no further rate cuts this year and possibly all the way through 2020.
Right.
Do you think that would be a mistake to stand pat on rates that long?
I think it totally depends on the data. I think it depends on Q3 earnings, PMIs, which we saw today. I think it depends on unemployment, layoffs. I think, again, it has to be data dependent.
So we've got New York Fed President John Williams, Chicago Fed President Charles Evans speaking this week as well. So lots and lots of Fed speak. The important thing is those two plus Bullard are voting members.
Right.
So we're really listening here to what they have to say. What do you expect to hear from the others?
I think it's going to be a similar theme of you've got some negatives and you've got some positives, and you're getting a lot of noise that people don't know what's going to happen and some uncertainty, right? Of course, the Fed chairs want to communicate that they hopefully know what's going to happen, but we don't. And I mean, that's not a bad thing, right? I mean, I'm sure you could look back in history, like in 2008, granted very different times,
right,
when you're kind of going through uncharted territory and you have to try out new things. I think we're in a much better shape than people in Europe, where they really might have just kind of got to the finish line and really monetary policy might have just done what it has to done what it could have done, and that be that. So I think it's just going to be a lot of uncertainty and a lot of, one person thinks this thing and one person thinks that thing.
Which is what investors have to get used to.
Right.
Yeah. What do you think the Fed's going to do next, though? I mean, with the next meeting, we still have another meeting here or two before the end of the year. Do you think that they are just going to take a breather because they keep saying they're data dependent and just see what the numbers show?
Yes. I think you have to. I think if the data does communicate that we are in fact slowing down, particularly the consumer, I think they're going to signal it. Now, the markets might demand a 25-point cut regardless of data, so I think that's an interesting point.
Yep.
Because I think the Fed is absolutely listening to the markets, probably maybe a little bit more than they should, but regardless, that's kind of where we're at.
Does the Fed matter as much in the short term for this market? We've had some guests on who say, you know what? It's really all about the China trade deal and whether or not we get one, and whether or not you're going to cut by a quarter point or 50 basis points or not cut at all really isn't going to move the needle that much. So the market is not going to be watching the Fed as closely as usual.
I think the market understands that the Fed is accommodating. And I think if the Fed communicated that they're going to raise, I think that'd be a very different story. I really think it comes down to earnings, and I think it comes down to the consumer.
Comes down to the basics, is what you're the fundamentals,
Absolutely,
right?
fundamentals.
All right, Michelle McKinnon, thank you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.